spend the next 10-15 minutes talking about and understanding what exactly is this fear or this threat to Indian IT companies, because we saw those stocks slide terribly. I mean, yesterday that entire index was down about 6%. You had key companies like Infosys, TCS, all of them sliding, and we'll show some of those hot spots to you as well. But meanwhile, conversation right now with Gurmeet Chadha, Managing Partner and CIO at Complete Circle, just to put it together. Gurmeet, thank you so much for joining us this morning. Do you think this is overblown or the pain is yet to come?
Good morning, Tamanna. Market always will react, always on the extreme both ways. And I think that AI-related threat to the application services is not new. What will happen over a period of time is that it has to be tested, So a chat box and smart plugins can solve, let's say, in a very simple language, level 1, level 2 kind of, let's say, services. But it's beyond that. A lot of the work requires very advanced software engineering skills, and I think it has to be more importantly tested with large projects and large clients. But as the impact gradually will come, and I think the future is more hybrid. It's about people who are able to use AI tools better with human capital, rather than it's being between AI tools and human capital. So I think some reaction in the market is always strong. I think what it could do is selectively, if I would put it, I would not paint everything with the same brush. You remember Y2K happened, then everything, obituaries were written, and then, web services
Gurmeet, my simple question is that would you use the dips of yesterday to buy? Is there enough confidence that this is overblown to come in and place bets? Or just actually buy into some of these stocks? Or is there still, we've not yet understood this whole picture, let's figure it out?
So a bit of both, Tamanna. So as I said, selectively yes, because for example, in large cap IT, HCL Tech, for example, has a software business which is, let's say, 10% of the revenue, but more than 20% of the EBITDA. It's a 25% margin business. Doesn't get highlighted too much, when large cap IT is considered. Similarly, selectively in mid-cap, small-cap valuations have become very, very reasonable. So KPIT Tech is not exactly related to what we are discussing, but it's more like an auto tech play. So selectively we can nibble, but as I said, gradually we are still underweight. I think IT would not be even 4% of the portfolio. But gradually we will see how it plays out, and if valuations become very reasonable, right? Let's say there's another correction and you start getting some of the IT names at 12, 14 times. Maybe yes, why not? I mean, have some bit of contras in play.
Hi, morning, Alex here. So, various perspectives and facets of this to discuss, right? So, but one argument has been that maybe the low-hanging fruit and the manual stuff is going to go out of the way, but these companies are going to be able to load up on AI themselves to improve some of their services, and to that extent, that will free up the ability to take on more projects that they might not have been able to do because of availability of bench strength or what have you. And so from that perspective, revenues might actually get bolstered even as margins get scrimped. Is that a way to look at it as well?
Yeah, Alex, I mean, maybe in few cases, yes. But as I said, the entire sector can't be painted with the same brush. Look at, for example, when Coforge acquired Encora, the market also reacted thinking, is this a great acquisition? If, it's more than 2 billion, 2.5 billion shares swap deal. So unfortunately, what happens is when somebody does capex or does get adventures, even then we get nervous. So but things pan out over a period of time. So I think it's a little early, as I said. And mind you, a lot of our IT services companies have a lot of cash, right? And who says that cash can't be utilized properly? But for now, as I said, you got to be a little more selective. Only from an investor point of view. See, one golden rule is, what you don't understand, you should not try and venture too much, especially in times like this. Right? So go for the low-hanging fruits, something where the earning visibility is more, disruption is less, and gradually let it evolve. But as I said, if you get sharp moves and get some of these names really cheap, it may not be a bad idea at least to tactically get into it.
But what about, okay, so that's the option if you haven't gotten it, right? But what if you're sitting with a portfolio that has a fair degree of exposure already to some of these IT names, Gurmeet? Do you duck for cover or do you hold out?
See, if your exposure is high, then definitely, you got to be a little worried. Also, if you see there's been a huge underperformance in last few years by Nifty IT over, let's say, if I take the benchmark. Look at some of the large names like TCS, Infi, Wipro, etc. They haven't done much, and the market has still done reasonably well on a broader basis. So if you are overexposed, yes, you might want to look at it, differently. But as I said, most of the portfolios, which I speak to, I track, both in terms of mutual funds or some of the stock portfolios, I don't see IT being an overexposed. So it's a little underowned in my view. And selectively you can, as I said, start looking for opportunities. I'm very excited on the mid-cap IT space because they have the ability to pivot. They have far more risk-taking ability, likes of Persistent, Coforge, maybe KPIT. And in large cap, you want to wait it out and see. As I said, we like HCL. We have a little bit of HCL in the portfolio.
Okay, so Persistent, Coforge, KPIT, HCL seem like possible buys at lower levels. Thank you so much for that, Gurmeet. Always a pleasure to speak with you.